Hims and Hers just had the biggest sales quarter in its history, $753 million in 3 months. Management also raised its sales forecast for the year, and the shares fell by roughly 5 to 7% right after the report. Here is the number that explains that gap. A year ago, this business kept 76 cents out of every dollar of sales after paying for the product itself. This quarter, it kept 64 cents. And in the same release, management cut the top end of its profit forecast. So the story here is not speed. Sales rose 38% this quarter. Profit fell 27%. Hims and Hers got bigger and less profitable in the same 3 months. Start with the growth, because the growth is real. That $753 million is how big the business is. It rose 38% in a year, and that is how fast it is growing. The company added about 300,000 paying subscribers in 3 months. Nearly 2.9 million people now pay every month around the world. The full-year sales plan went up to between $3.1 and $3.3 billion. Next quarter is guided to growth of roughly 50%, which is a projection, not a result. Now look at the part that gets less attention. Sales outside the United States were $131 million. A year earlier, that number was about $7.5 million, so it is more than 17 times bigger. But roughly 40 million of it came from Eucalyptus, an Australian digital health company bought in June. That was the largest acquisition in company history, at close to $1 billion in total. Take that $40 million out, and what is left is $713 million. Against $545 million a year earlier, the business the company already had grew 31%. The acquisition supplied the other 7 points. That is still fast, just not the headline number. Some of the new subscribers arrived with the acquisition, too, rather than being one. The chief financial officer said Eucalyptus was running at break-even to moderate losses, so it added sales immediately and close to no profit. Buying revenue and building it both lift the growth rate. They are not the same thing. Now comes the number that decides whether any of this turns into profit. It is called gross margin. It is how much of each dollar of sales is left after paying for the product itself. Picture a coffee shop. A cup sells for $5, the beans and cup cost $1, so the shop keeps $4. Here is the trend, and it runs one way. 2 years ago, Hims and Hers kept 81 cents of every dollar. A year ago, it kept 76. Last quarter, it kept 65. This quarter, it kept 64. Then come all the other costs, like marketing, salaries, and technology. After those, the company kept roughly 8 cents of adjusted operating profit per dollar. That is profit before interest, taxes, and certain accounting charges. It leaves out those one-time charges too, so it is the fairest way to judge the business itself. It is also the measure management steers by. Now put the two together, because this is the heart of it. Sales rose 38%, from $545 million to $753 million. Adjusted operating profit went the other way, from $82 million down to $60 million. That is a fall of 27% in the same year. Now look at the bars underneath that line. The company lost $86 million this quarter on paper. About $81 million of that came from one-time charges, mostly money set aside for the lawsuit and the cost of the acquisition. Strip those out and a far smaller loss remains. So here is the one thing to remember from this video. Watch what this company keeps, not what it sells. The chief financial officer was direct about the cause. In his words, as branded weight loss products and international revenue become a larger portion of the business, gross margins will remain below the levels historically achieved. That is management saying the change is not a one-quarter accident. And it showed up in the forecast. The sales range went up. The profit range did not, and the top end was cut from $350 million to $325. One headline that day read, lowers profit forecast. Here is why that matters more than any growth figure. Management has a public target for 2030. It is $6.5 billion of sales and $1.3 billion of that same adjusted operating profit. Divide the second by the first. That is 20 cents on every dollar. This quarter delivered 8 cents. So the plan asks that number to more than double in 4 years, while the mix keeps shifting toward lower margin products. That is the real bet, not the sales line. Now consider the strongest argument that the falling margin is the plan, not the problem. First, this company has run this play before, and it worked. In hair loss and sexual health, scale led at lower prices. Lower prices brought more customers who stayed longer and were worth more. Management says weight loss is the same play, one stage earlier. And look at what the money actually went on. The acquisition bought 5 countries at once. The artificial intelligence work lowers the cost of serving every customer who comes after. The pharmacies and labs open categories the company cannot sell yet. None of that shows up as profit in the quarter it is paid for. Those are the marks of a company building a base, rather than one simply losing ground. Second, the base is getting broader, and a company carried by one product is fragile. 5 American specialties each run above $100 million a year. Testosterone launched only about 3 quarters ago and is already the fastest growing part of the business outside weight loss. While the argument was about margins and a lawsuit, it went from nothing to nearly $100 million a year quietly in 9 months. 3 countries clear that same line: the United Kingdom, Australia, and Germany. Third, and this is the newest evidence, the artificial intelligence claims finally have numbers behind them. In early July, it gave women's weight loss customers a new care experience built on it. Those customers now send 3 times as many messages, and artificial intelligence answers about 80% of their questions. Routine work handled by human staff fell by about half, and some leverage is showing. Marketing took about 35 cents of every sales dollar, down 5 cents in a year. Adjusted profit per dollar ticked up from about 7 cents last quarter to 8, and each subscriber is now worth more. Last quarter, the company earned about $80 a month from the average subscriber by its own published figure. This quarter, on the same measure, it works out to about 92. That second number is a calculation, not one the company gave. Part of the rise is simply that branded weight loss drugs cost more than what came before. Underneath all of it sits a subscription business, and that money arrives whether or not anyone runs an advertisement that day. Over the past 12 months, it produced more than $260 million of cash. It ended the quarter with more than $840 million in the bank. And the prize is one of the largest markets on Earth. Here is a lighter one for the comments. Name the one health thing you would genuinely handle through an app, and the one you never would. Now the risks, each with the reason it matters to you. First, the margin decline is structural, and management said so out loud. That matters because sales can keep growing fast while the profit inside every dollar shrinks. That is exactly what happened, and the 2030 target needs the opposite. Second, the fastest growing product is not the company's own. It sells the branded weight loss drug made by Novo Nordisk, the Danish drug maker behind Wegovy. That matters because Hims and Hers does not set the price and does not own the product. Novo Nordisk sells directly to patients itself, and so does Eli Lilly, which makes the rival drug Zepbound. Ro, LifeMD, Amazon, and a government-backed website all sell them too. All of that puts a ceiling on price, and price is where margin lives. Third is the lawsuit. The Federal Trade Commission, the American agency that polices business practices, filed a complaint on the 29th of July, and 2 states joined it. The lead charge is privacy over health information shared with advertising platforms. Other counts cover how subscribers were signed up and how hard it was to cancel. The company set aside $47.5 million and says it will fight. That matters because the cost and the timing are both unknown, and those counts touch the engine behind every growth number here. Fourth is cash. Cash from running the business was negative $36 million this quarter. After equipment and other spending, free cash flow was negative $68 million. Now look at the line running across that chart. It shows how much of each sales dollar turned into cash. At its best, it ran above 20 cents. Over the past 12 months, it was about 10. This quarter, it fell below zero for only the second time in 3 years. Both of those were second quarters. Management calls this a timing effect because monthly branded drugs tie up money before subscribers pay it back. It expects cash to turn positive in the second half. And the one-time charges do not rescue this. The largest, the lawsuit money, was never actually paid, so it never left the bank. Take out what did leave, and cash still lands near zero. To bridge the gap, it arranged a $400 million receivables facility, and in May raised $400 million of convertible debt. That matters because growth is now partly financed rather than self-funded, and that debt can turn into shares that shrink every existing owner's slice. Fifth, and this is the quiet one, several numbers were simply not given. There was no retention rate for the branded weight loss customers and no profit figure for the company just bought. That matters because you are relying on outside estimates for the parts that decide the case. A company usually withholds a number when it does not help. Here is what to watch, in order. First, watch gross margin next quarter. It was 64 cents on the dollar this time, down from 76 a year earlier. Whether it steadies or keeps sliding is the cleanest read on this whole story. Watch too whether weight loss prices get cut this year, which would push it down again on purpose. Second, watch free cash flow in the third quarter. Management promised a return to positive in the second half. That is the promise with the date attached. Third, watch for one number the company has never published. Its answer to the falling margin is to sell more than one thing to each customer. Someone arrives for weight loss, takes a blood test, and that test finds something else worth treating. The second treatment costs almost nothing to win because the customer is already there. That is the cheapest revenue a company can get. But it has never said how many people actually buy a second thing. It did not say last quarter, and it did not say this quarter. Here is the one thing this whole story rests on. It is that a bigger hims and hers will keep more of every dollar than a smaller one did. That is the whole case, and it will take years to answer, not quarters. What this quarter bought was a wider base. What it did not buy was any sign that the base earns more per dollar yet. So here is a fair thing to argue about below. Management says that by 2030, it will keep 20 cents of every dollar against 8 cents today. Pick your own number for that year and say which of this year's costs you think will still be paying off by then. The record sales are real, and so are the costs. Watch what this company keeps, not what it sells. If you want a company's quarter stripped down to the one number that actually decides it, subscribe, and the next one will do the same. One last thing, the content in this video is for reference only and does not constitute investment advice. All investments carry risk. Please make your own judgment based on your personal circumstances.